Welcome to my Accounting 2310 pencast on the series of revenue or income recognition. I have a goal for today. That goal is to learn how to recognize revenue using the installment method. Let's get a little time chart up. The installment method happens after delivery. So delivery takes place, but because there's some uncertainty as to the collection of costs, we put off recognizing revenue and instead recognize it using the installment method. The installment method usually applies to long-term contracts like sales of real estate or land. And because there's more uncertainty because of the length of time involved, generally accepted accounting principles require that you use the installment method. This is also a popular method when working with the IRS, this note of interest. Let me bring forward some facts for you to work with. Let me put this on pause and I'll grab some information we can use to move forward with. Let's assume that we're looking at a business that has a lot of sales, only some of which are on the installment basis. And we have some information for 2013. Our installment sales for that year, $360. Our cost of goods sold relating to those installment sales are $234. And if we were using point of sales revenue recognition, we would pick up $126,000. Let's assume further that we have some cash collections that we are able to collect during 2013 as well. So again, these are collections for the year 2013 sales. Let's say we collected $150,000 during the year towards our sales. I'd like to compute the gross profit margin rate on this. If sales were 100%, can you state cost of goods sold and gross profit as a percent of those sales? $234,000 over our total, $360, that kind of an idea. Divide that out and you'll find out our cost of goods sold are running 65% of sales. And if you do the same with the $126,000, our gross margin is running 35% of sales. This becomes important, so let's note that before we start. Let's add some information for 2014. Our sales for 2014 that were completed using the installment method totaled $350. Costs relating to those, $245. Gross profit, 30%. If you do the gross profit margin calculation information again, sales being 100%, divide costs and you'll find they're running at about 70%. And gross profit for the year 2013 is 30%. Let's review what these two gross profit figures really mean. What happens in 2013 is for every dollar we collect, 35% is profit, assuming we collect all dollars. And for 2014, every dollar we collect is 30% profit, again, assuming we collect all dollars. Let's look at our cash collections for the year 2014 now. In 2014, we collect some money on our sales for 2013. So in 2014, I'm going to collect $100,000 on my 2013 sales. Notice it's on my 2013 line. And I'm going to collect $120 on the sales I had for 2014. So during the year 2014, my total cash collections will be $220,000. Some for 13 and some for 14. 2013, they totaled $150. I'm going to use these facts for both the installment method demonstration on this pencast and the cost recovery method on the next pencast. First thing I want to do is journalize transactions. So let's first journalize transactions using the installment method. Let's record the journal entry to record the sales. I'll do this quickly. Our installment receivable for the 2013 sales We're working on 213 here. Installment receivable is $360,000, so I'll record that. And then I'm going to take inventory off. So take off inventory in the amount of $234,000, and I am going to set up a new account that's called deferred, a little abbreviation here, deferred gross profit. And that is the difference, $126,000. Never heard of that account before. It's a contra account. It's contra to installment receivables. We'll look at that in a little bit. So that records the sales for 2013. Now let's record the cash we received. We received $150,000, as you can see. So I will debit cash for $150,000. And I will credit installment receivables because I was able to collect for $150,000. Now remember, we said for every dollar we collect, 35% would be gross profit. So since I've collected $150,000, I need to recognize 35% of that as gross profit. So I will take my deferred gross profit account down by 35% of this amount. There you go. 35% of 150,000 is 52,500. So I'm going to put that in an account your author calls earned gross profit. An income statement account, a revenue account. It is net. It is not sales and cost of goods sold. It's just 35% of collections. And again, where did I get that? Well, I collected $150,000 on these sales, and I said 35% of that, my gross profit rate for this year, is profit. 150,000 times 35,000, 52,500. So that is the amount of gross profit I earn for the year. That was kind of fun. Let's do the same thing for 2014. Let's journalize the transactions. Well, we have an installment receivable for the sales that are installment based in 2014 of $350,000. You can see that number right here. I'll take out of inventory the amount of our cost of goods sold, $245,000, but I'm not taking it to the income statement as cost of goods sold. I'm just taking it off of inventory. And then I'm going to set up the deferred gross profit for the year. Put that in the deferred gross profit account in the amount of $105,000. And that represents deferred gross profit on 2014 sales. Let's get down to our cash collections for 2014. You can see we collected $220,000. So cash, $220,000. An installment receivable. Take it off my receivable. Just a regular payment. $220,000. Well, how much of that was gross profit? We need to figure out now how much we can take out of deferred gross profit and recognize as our author calls it, earned gross profit, actually putting it on the income statement. We had cash collections, 2013 cash collections. We collected $100,000, and we say that 35% of that is profit. So we have $35,000 from 2013 sales. We also collected some from 2014. In fact, we collected, you'll notice, $120,000. So there's our $220,000 in cash collection, some for each year. And you'll recall that our gross profit rate for 2014 was 30%. 30% of $120,000 is $36,000. Add those two together and they equal $71,000. So I can undefer, I made that word up, I think, $71,000 worth of gross profit because I have now collected it. So, for every dollar I'm collecting from 2013, 35% is profit. And for every dollar I'm collecting for 2014, 30% is gross profit. So for 2014, earned gross profit is $71,000. Fantastic. Look at that. So, now you've seen the journal entries, how to journalize transactions for the installment method. Let's look at how they'll look on the financial statements. I want you to remember some numbers. I want you to remember that for 2013, our earned gross profit is $52,500, but my sales were $360 and I collected cash of $150. Remember those amounts, and now let's see how that will look on our financial statements. Ink, paper everywhere. Hold on. So, the question is then, how, not W, can't spell, huh? How are the financial statements impacted by this installment method of accounting? Let's look first at the income statement and see how that would look. Recall we said our business only had part of the revenue coming from installment sales, so the other revenue would show up in sales normally on the income statement, and there would be cost of goods sold that relate to those sales, and that would have been recorded normally. So on the income statement you would have some gross profit that comes about from your regular sales, whatever that number is. I'm going to insert a new line to the income statements right here, and this is gross profit from installment sales. And you'll recall in our example it was $52,500 for 2013. So it would be added in here. Then gross profit plus gross profit from installment sales would be added together, and this would equal total gross profit. So we brought forward just the amount of gross profit that we earned from 2013. And again, this income statement is just for 2013. 2014 would be the same way. Notice the sales aren't captured and the cost of goods sold aren't captured, just the gross profit is. And so you would have to put a note to the financial statements that told the readers how much the sales related to this gross profit were and what the cost of goods sold. Then you would finish the income statement normally, subtracting whatever expenses are left off, and then determining after that net income. So, in answer to the question, how are financial statements impacted? For the income statement, we add one line where we insert gross profit that is earned from installment sales. Let's turn our attention to the balance sheet now. And again, I'm just going to present 2013. We had some accounts we were working with. I think I'd like to copy over. We had installment receivables in 2013, and we had deferred gross profit from 2013, and we collected some cash. I'd like to put those numbers in. So, going back to page 69, you recall it's not page 69 to you, is it? Going back to our example, you'll recall our sales were $360,000. So I record that in our installment receivable, and I get that from information from our example we're currently using. And I'll pick up our deferred gross profit now as well, the $126,000. And I want you to divide the $126,000 and the 360, and you'll notice, yes, that the 35% relationship is intact. This is in fact 35% of our installment receivable. Then I want to remind you that we also collected $150,000 on those sales. And so out of accounts receivable came $150,000, leaving in installment receivables $360 minus $150, $210,000. As soon as we picked up the $150, we removed 35% of that out of deferred gross profit into earned gross profit. And as you'll recall, that was $52,500, the amount we put on the income statement. And so our deferred gross profit balance is $73,500. So on our balance sheet, under assets, we have an installment receivable in the amount of $210,000. And then we have a contra account to that, known as deferred gross profit, which should be running 35% of it, in the amount of $73,500. So our net installment receivables shown on the balance sheet would be the difference between the two, or $136,500. Since right now we only have sales in there at 35%, let's see if deferred gross profit is running 35% of the account of the installment receivable. $73,500 divided by $210,000 equals, yes, it does. That is running at the true 35%. Just wanted to note that for you. So our balance sheet is showing how much we have tied up in it, receivable-wise, how much profit we have still to realize, subtracting one from the other, and showing it as a net installment receivable. So that's how our financial statements are impacted by using the installment method of accounting. Let's summarize then. How much revenue recognition was there under the installment method? Well, in 2013, there was $52,500. That was 35% of the collections on 2013 sales. And in 2014, you'll recall, there was $71,000, and that was 35% of collections for 2013 and 30% of collections for 2014. So that is the amount of revenue recognition that is shown. And deferred gross profit, what kind of account is that? It's a new account. We haven't looked at it before. We are treating it as a contra asset, contra to the installment receivable account. So there's a look at journal entries and how they affect the financial statements, and a summary of revenue recognition and what's happening with the deferred gross profit account for you. Hey, thanks for joining me. Time to move on to cost recovery.